And it all started out up above around 38 even here now, guys, talking about 25 handles of solid sell side activity here, guys. They have just peas trading now, guys. 75 even done trading, 4 even done trading, 2 even done trading.
Down by 4-5%. We're down over 16%, has fallen about 18%.
Because we're now down 43%.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere. What in the world is happening on Wall Street?
In an era where speed defines success, the financial world operates at an almost incomprehensible pace. On a trading floor teeming with life, in the heartbeat of a mouse click, catastrophe strikes. Billions of dollars evaporate in milliseconds, leaving behind confusion, panic, and a market in disarray. But what lurks behind these mysterious market events? Welcome to Flash Crashes, the millisecond events that shook the financial world. Flash crashes are not mere accidents. They are an intricate web of causes and effects, intertwined with technology, psychology, and the unpredictable nature of markets. They're like watching a finely tuned orchestra suddenly descend into chaos, leaving audiences stunned and bewildered. In the high-speed world of electronic trading, where transactions can occur in less than a millisecond, algorithms play a key role. These computer-driven systems are programmed to analyze market trends, make predictions, and execute trades at incredible speeds. Yet they lack the human intuition and emotional intelligence that often govern traditional trading decisions. This absence of human oversight can lead to unexpected reactions, where the algorithm misinterprets market signals and responds with a flurry of sell or buy orders, pushing prices to irrational extremes. Moreover, high-frequency trading firms are often engaged in a relentless competition to be faster, shaving microseconds off their execution times. This race for speed can lead to overreaction, where multiple algorithms start to behave like a pack.
So at the top you have high-frequency trading and proprietary trading desks in the big banks. That's the main. That's the party that everyone else is trying to serve or be a part of. Underneath them you have the exchanges, and the exchange's entire business model now revolves around volume. So the exchanges work hard to court HFT, to attract them to their venues, and therefore to attract the volume. And the brokers are the ones routing orders to the exchanges, and they're making money off commissions from their buy-siders. So at the bottom is the buy side. The buy side are the pension funds and the mutual funds. They're the investors. They're the ones who are actually there because they think that a company has good prospects or good fundamentals.
Following each other down a path that leads to a sudden and dramatic crash. But it's not just technology at play. Human decisions contribute as well. Large sell orders from institutional investors can act as the initial spark, setting off a chain reaction. In some cases, market participants may be attempting to manipulate the market, using techniques like spoofing, where they place large buy or sell orders with no intention of fulfilling them, creating artificial supply or demand. Regulatory mechanisms also play a part. Some marketplaces employ circuit breakers designed to halt trading when prices swing too wildly.
There's the circuit breaker, 25, 49, 48, and the bell. So we'll wait here. We'll suspend trading for 15 minutes.
Oh, we got 15 minutes.
We'll see what happens after that.
However, these safety measures can sometimes have unintended consequences, causing confusion or even exacerbating the panic, as traders are left in the dark during these temporary stoppages. Finally, the interconnectedness of global financial systems means that a flash crash in one market can easily spill over into others. In a world where everything is linked, a tremor in one area can send shockwaves around the globe. The anatomy of a flash crash is a complex puzzle, a mixture of human psychology, technological prowess, regulatory mechanisms, and the inherent unpredictability of financial markets. It's a window into the soul of modern finance, where logic and emotion clash, where machines and humans vie for control, and where the delicate balance can be shattered in the blink of an eye. The mystery of flash crashes continues to perplex and fascinate, a stark reminder that in the world of finance, stability can be as elusive as a shadow. The May 6, 2010 flash crash, a day forever etched in financial history. Markets were already jittery due to the European sovereign debt crisis. Then, at 2:32 p.m. Eastern Time, the unthinkable happened. The Dow Jones Industrial Average plunged over 1,000 points, or about 9%, within minutes. Blue-chip stocks like Procter & Gamble saw their share prices collapse to nearly a penny. The culprit? An unusually large sell order by a mutual fund, executed by algorithms, combined with high-frequency trading gone awry. The market recovered most of its losses within the hour, but the damage was done. The 2010 flash crash exposed the fragility of a system heavily reliant on automated trading and led to regulatory reforms. Brexit flash crash, a different type of flash crash driven by political turmoil. On June 23, 2016, Britain voted to leave the European Union, an event that sent shockwaves through financial markets. The uncertainty surrounding the vote led to extreme volatility. The British pound fell as much as 10% against the dollar in a matter of hours, an unprecedented move for a major currency. This wasn't a flash crash in the traditional sense caused by algorithmic trading, but rather a response to a profound political event. Yet it serves as a reminder that flash crashes can occur outside the realm of high-frequency trading, where human emotions and reactions to significant events can lead to sudden and dramatic market movements. These incidents demonstrate the multifaceted nature of flash crashes. Whether caused by a complex interplay of algorithms and large trades like in 2010, or by human reaction to unforeseen political events, as with the Brexit crash, they underline the delicate and often unpredictable nature of global financial markets. Each crash offers lessons, insights, and sometimes reforms. But as the markets evolve, so do the risks, and the spectre of flash crashes continues to loom, a haunting reminder of the vulnerability of our interconnected financial world. The role of technology in the world of finance is a double-edged sword. On one side, it provides unprecedented efficiency, speed, and accessibility. On the other, it introduces new vulnerabilities, complexities, and uncharted territories that can lead to flash crashes.
When you buy a stock, you buy it at a price, and then for the next person to buy it, they have to pay more. So that margin was the advantage that a lot of these HFT organizations could take advantage of. Now, it's minuscule in terms of the amounts, but when you do it millions and millions of times, it creates tremendous revenue over a period of time.
High-frequency trading, HFT, is at the heart of this technological revolution. Enabled by supercomputers and sophisticated algorithms, HFT firms execute trades in microseconds, searching for tiny price advantages in the market. This high-speed trading has transformed the financial landscape, but it has also brought new risks. The May 6, 2010 flash crash was a stark example, where a flood of sell orders from HFT algorithms led to a rapid market collapse. But why do these algorithms react this way? The answer lies in their design. Many high-frequency trading algorithms are programmed to detect patterns, trends, and anomalies in market data. When they sense a change, such as a large sell order, they may respond aggressively, amplifying the impact of the initial event. This reaction can trigger other algorithms to do the same, leading to a cascading effect that spirals out of control. Furthermore, the lack of transparency in some dark pools and over-the-counter markets allows these algorithms to operate in shadows. Without proper oversight, they can execute massive trades that might disrupt the broader market without warning. Market fragmentation also contributes to the problem. With hundreds of trading venues and platforms, each with its own rules and dynamics, technology must navigate a maze of complexity.
Market fragmentation is the concept that all markets are diverse and composed of different segments, reflecting different needs, wants, responses to marketing messages, and behavior. These many segments that characterize all markets are indicative of the fragmentation of these markets. Think of all the TV channels you have, all the magazines you can read, all the soft drinks and cereals you can consume, all the iPhone's apps you can explore, and you start getting a feel for market fragmentation.
This fragmentation can create information asymmetries and gaps, where prices differ significantly between venues, providing fertile ground for flash crashes to occur. The rise of social media and instant news has added another layer to the technology's impact. Market-moving news can now spread like wildfire, triggering algorithms that monitor news feeds to react instantaneously. This interplay between news, sentiment, and automated trading adds to the volatility and unpredictability of modern markets. Technology has brought us to an era where trades can be executed at the speed of light, where algorithms make decisions devoid of human emotion or oversight, and where the global interconnectedness of markets means that a tremor in one part of the world can cause an earthquake in another. The role of technology in flash crashes is a profound and complex subject, filled with both marvel and caution. It's a dance between human ingenuity and machine precision, where even a slight misstep can lead to chaos. The challenge lies in harnessing this incredible power without losing control, in creating a financial world that's not only fast and efficient but also stable and resilient. In the quest for technological supremacy, we must not lose sight of the fundamental principles that govern the stability and integrity of our financial systems. Flash crashes, with their profound impact on markets and individuals, have led to intense scrutiny from regulators, policymakers, and market participants. The regulatory response has been a complex and contentious journey, full of debates, controversies, and ongoing challenges. After the May 6, 2010 flash crash, regulators were under immense pressure to investigate and address the underlying causes. The Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC, jointly published a report identifying an interplay between high-frequency trading and traditional market makers as a significant factor. This led to the introduction of measures like circuit breakers, which temporarily halt trading if a significant price movement occurs within a short period. These mechanisms aim to provide a cooling-off period, allowing the market to digest information and preventing panic selling. While these measures have been praised by some as necessary safeguards, they have also faced criticism. Detractors argue that they can create additional uncertainty and may not address the root causes of flash crashes. Regulators have also focused on high-frequency trading, HFT firms, which use advanced algorithms to trade at lightning speed. While HFT contributes to liquidity and can enhance market efficiency, it has been accused of exacerbating volatility during flash crashes. Regulations have sought to impose risk controls and transparency requirements on HFT, but the debate is far from settled. Some see HFT as a scapegoat, while others view it as a fundamental risk that needs stringent oversight. The regulatory landscape has also been complicated by the global nature of financial markets. Flash crashes can have cross-border implications, necessitating coordinated international efforts. Yet, differing regulatory philosophies and market structures can lead to conflicting approaches, creating confusion and potential regulatory arbitrage. Furthermore, some critics argue that the regulatory focus on flash crashes misses the bigger picture. They contend that by concentrating on rare and extraordinary events, regulators may overlook more pervasive and systemic issues that threaten market stability. This has led to calls for a more holistic approach that considers market dynamics, human behavior, and broader financial stability. In the wake of Brexit and other politically induced market events, regulators have also had to grapple with the challenge of distinguishing natural market reactions from potentially disruptive flash crashes. This blurred line between political events and technological factors adds another layer of complexity to regulatory efforts. The regulatory response to flash crashes is a story of struggle, adaptation, and ongoing tension. It reflects the intricate and ever-changing nature of modern financial markets, where technology, human behavior, global interconnectedness, and political realities intersect in unpredictable ways. Regulators are tasked with an unenviable balancing act to ensure stability and protect investors without stifling innovation or overburdening market participants. Controversies and debates continue to rage, reflecting deeper philosophical differences about the role of government, the nature of markets, and the ethical responsibilities of participants. The regulatory response to flash crashes is not merely a technical matter. It's a complex and morally charged issue that resonates with broader societal values and principles. As we look to the future, The challenge is to foster a regulatory environment that is adaptive, thoughtful, and rooted in a nuanced understanding of the market's multifaceted nature. It's a task that demands not just technical expertise, but a willingness to engage with the profound ethical and philosophical questions that lie at the heart of financial regulation. In a world where flash crashes are a reality, the quest for a just and stable financial system is an ongoing journey, fraught with complexity, contention, and profound implications for our collective well-being. As we navigate this intricate web, the questions posed by flash crashes reach beyond mere economics, probing into the very essence of our relationship with the digital age. They challenge us to confront not just how we trade, but how we live, how we connect, and how we envision our place in a rapidly evolving universe. In seeking to understand flash crashes, we are, in truth, seeking to understand ourselves. A quest that, like the markets themselves, is filled with uncertainty, beauty, and infinite complexity.